Before we dive in, please remember that I am not a licensed financial advisor, mortgage broker, or real estate agent. The information provided in this video is for educational and informational purposes only and should not be considered financial or legal advice. The home buying process is complex, so please consult with qualified professionals before making any financial decisions. Imagine this for a second. You've done it. After months of scrolling endless open houses and late-night Zillow sessions, you found the one. The perfect house. It has the backyard for the dog, the extra room for a home office, the kitchen you've been dreaming about. Your heart is pounding. You and your agent craft the perfect offer. You even write one of those heartfelt letters to the seller. You're confident. You're excited. You've got a letter from your bank that says you're good for the money. And then you get the call. The seller went with another offer. It wasn't higher than yours. In fact, it might have even been a little lower. So what happened? The other buyer had a different piece of paper. A document that screamed, "I'm a serious, reliable buyer, and my money is guaranteed." While your letter just whispered, "I'm interested." That one tiny difference, a difference most people don't even know exists, just cost you your dream home. This scenario plays out every single day in the American real estate market. And the heartbreaking truth is, it's entirely avoidable. The single biggest mistake that costs potential homeowners their perfect house isn't a low offer or bad credit. It's the catastrophic misunderstanding between two simple terms: mortgage pre-qualification and mortgage pre-approval. They sound almost identical. Your bank might even use them interchangeably. But in the eyes of a home seller, they are night and day. One is a suggestion. The other is a promise. One is a maybe. The other is a near certainty. Understanding this difference isn't just a good idea. It is your single greatest competitive advantage in today's cutthroat housing market. It's the secret weapon that gets your offer accepted over others. It's the key that turns you from a window shopper into a power buyer. So what are we going to do today? We are going to demystify this once and for all. By the end of this video, you will know exactly what a pre-qualification is, what a pre-approval is, which one you absolutely need, when to get it, and how to leverage it to make your offer so compelling that sellers can't ignore it. We're going to transform you from someone who hopes to buy a house into someone who is ready to buy a house. This knowledge will save you time, it will save you stress, and as we just saw, it could literally be the one thing that gets you the keys to the house you love. Let's start with the one that causes all the confusion, the pre-qualification. Think of a mortgage pre-qualification as a first date. It's a casual conversation. It's a quick, informal check to see if there's even a possibility of a future together. You call up a lender or fill out a 10-minute form online. You tell them your income. You tell them your estimated monthly debts, car payment, student loans, credit card bills. You give them a rough idea of your savings and your credit score. You're giving them all this information based on the honor system. You're just telling them the numbers. You're not proving anything. Based on this self-reported, unverified information, the lender runs a few basic calculations. They're essentially taking your word for it. They don't pull your credit report. They don't ask for your tax returns, your W-2s, or your bank statements. They take the numbers you gave them, plug them into a simple formula, and say, "Okay, based on what you've told us, you could probably afford a mortgage of around, say, $400,000. And then they print out a letter for you that says just that. Pre-qualification letter. Now, does this sound a little flimsy? It should, because it is. A pre-qualification is not a commitment to lend you money. It's not even a serious indication that you'll be approved for a loan. It's a ballpark estimate. It's the financial equivalent of a back-of-the-napkin calculation. It holds very little weight because nothing has been verified. What if you accidentally overestimated your income? What if you forgot about that old student loan? What if your credit score is actually 50 points lower than you thought? Any of these things could completely disqualify you from getting the actual loan, and the pre-qualification letter would be worthless. So, if it's so flimsy, why does it even exist? Well, it does have a very specific, very limited purpose. A pre-qualification is for you and you alone. It's your first step on the financial ladder of homeownership. It's for when you're 6 months or a year away from buying, and you're just trying to get a rough idea of your budget. It helps you answer the question, am I even in the ballpark to buy a home in my area? It can give you a starting point for your online home search, so you're not looking at million-dollar mansions when your budget is closer to a 2-bedroom condo. It's a private, personal tool for your own planning. The critical mistake people make is thinking this letter is for the seller. They get this piece of paper, they feel a false sense of security, and they start making offers. But here's the reality check. A savvy real estate agent and a smart home seller know exactly what a pre-qualification is and what it isn't. When they see that word, pre-qualification, on your offer letter, they see risk. They see a buyer whose finances haven't been checked. They see a deal that has a high probability of falling apart in the final stages, wasting weeks of their time and forcing them to put their house back on the market. In a competitive situation with multiple offers, the offer with a simple pre-qualification letter is almost always the first one to hit the shredder. It signals you're not a serious buyer. It signals you haven't done your homework. So, if a pre-qualification is just a casual first date based on unverified conversation, what's the alternative? What's the document that makes sellers see you as the real deal? That's where the mortgage pre-approval comes in. And this, my friends, is the game changer. If a pre-qualification is the first date, a pre-approval is like proposing. It's a serious commitment. It's a deep, thorough, and verified investigation into your financial life. It's no longer a conversation. It's an application. This isn't a 10-minute online form. This is you rolling up your sleeves and proving with cold, hard documentation that you are who you say you are and you can afford what you say you can afford. This process is far more rigorous, and for good reason, because at the end of it, you don't get a flimsy estimate. You get a conditional commitment from a lender to give you a specific amount of money for a home. This is the golden ticket. This is what separates the dreamers from the buyers. And getting one requires you to open up your entire financial world to an underwriter. And that underwriter is essentially a financial detective. Their one and only job is to look at your life, document it on paper, and decide if you are a good bet for the bank. They don't know you. They don't care about your dreams of a white picket fence or a home office. They care about one thing: risk. Are you a risk? To prove you're not, you have to undergo what many in the industry call a financial colonoscopy. It's invasive, it's uncomfortable, but it's absolutely necessary. So what does this deep dive actually look like? Get ready to open a new folder on your computer, because you're going to be saving a lot of PDFs. First, they'll want your most recent pay stubs, usually for the last 30 days. This proves your current income. It shows them what's hitting your bank account right now. But what you're making today isn't enough. They need to see a pattern. They need to know this isn't some new high-paying job you might lose in 6 months. That's where your W-2s and tax returns come in. They'll typically ask for the last 2 years. This establishes your earnings history. It tells a story of stability. If you're self-employed or a freelancer, this step is even more crucial. They're going to want to see 2 years of tax returns every single page, and they'll likely average your income over that period to account for the natural ups and downs of running your own business. Next, get ready for the big one: your bank statements. And not just a screenshot of your account balance. They want the full official statements for the last 2 to 3 months, sometimes more. And here's a pro tip that trips up so many people. They need every single page. Even if page 7 of 7 is a completely blank piece of paper with just a page number on it, you send it. If you send a statement that says page 1 of 7, and you only send them 6 pages, they will kick it back. Why? Because they need to verify that nothing is being hidden. They are looking for 2 main things. First, do you have enough cash for the down payment and the closing cost? They call this sourcing of funds. They need to see that money sitting in your account seasoned for a period of time. This brings us to the second thing they're looking for: large, unusual deposits. Did your rich aunt suddenly gift you $20,000 for a down payment? That's amazing, but to the underwriter, it's a giant red flag until you prove what it is. It could be an undisclosed loan from a friend, which would count as a debt and throw off your entire application. So if you have a gift, you'll need a signed gift letter from the person who gave you the money, explicitly stating that the money is a gift and not a loan that needs to be repaid. You'll also need to show the paper trail of that money leaving their account and entering yours. Yes, it's that detailed. They're also scrutinizing your spending. Are you making regular payments to an account they don't know about? Do you have a gambling problem? They are building a complete picture of your financial habits. They'll also ask for statements from any other asset accounts you have, your 401k, brokerage accounts, IRAs. This demonstrates your overall financial health and your ability to handle unexpected expenses after you buy the house. And of course, they'll need copies of your driver's license and your social security card to verify your identity. After you've gathered this mountain of paperwork and sent it to your loan officer, the real moment of truth arrives. The lender will ask for your permission to perform a hard credit pull. This is a pivotal moment. A hard pull, or hard inquiry, is an official request to see your full credit report from one of the three major bureaus: Equifax, Experian, or TransUnion. This is different from the soft pulls you might see from credit card companies sending you junk mail. A hard pull signals to the credit bureaus that you are actively seeking new credit, and it can cause your credit score to dip by a few points temporarily. This is the part that scares a lot of people. They've heard that inquiries hurt your score, so they're afraid to shop around for the best mortgage rate. But here is one of the most valuable pieces of information you will ever get about this process. The credit scoring models are smart. They know you're not trying to buy 5 houses at once. They understand that shopping for a single large loan like a mortgage or a car loan is normal behavior. Because of this, any mortgage-related hard pulls that occur within a specific window, usually 14 to 45 days depending on the scoring model, are treated as a single inquiry. Let me say that again. You can have your credit pulled by 5 different mortgage lenders in a 3-week period, and it will only impact your score as if it were one single pull. This is designed to empower you, the consumer, to shop for the best possible interest rate without fear of wrecking your credit. Do not let fear of a hard pull stop you from finding a loan that could save you tens of thousands of dollars over the next 30 years. So the underwriter takes all this: your income history, your bank statements, your asset accounts, your freshly pulled credit report, and they put it all through a fine-toothed comb. They verify everything. They calculate something called your debt-to-income ratio, or DTI, which is a critical number we'll dive into later. And after days, sometimes a week or more of this intense scrutiny, if you check all the boxes, they issue it, the pre-approval letter. This is a document with a dollar amount on it. A real, verified, underwritten number that a bank is conditionally committing to lend you. This letter is your sword and shield in the real estate market. Now let's talk about its weaker, less impressive cousin, the pre-qualification. If a pre-approval is a full medical exam with blood tests and MRI, and a doctor's final diagnosis, a pre-qualification is you walking into the doctor's office and saying, "Hey doc, I'm 35, I think my blood pressure is pretty good, and I eat a salad sometimes. Am I healthy?" The doctor might say, "Yeah, you sound healthy," but he hasn't run a single test. That's pre-qualification. It is a surface-level, 10-minute conversation. You call a lender or fill out a form online. You tell them what you make. You tell them what you have in the bank. You tell them what you think your credit score is. You are self-reporting all of this information. The key difference is this: none of it is verified. There's no financial colonoscopy, no W-2s, no tax returns, no bank statements. Most importantly, there is no hard credit pull. The lender is taking you at your word. Based on this unverified information, they'll run a simple calculation and say something like, "Okay, based on what you've told us, you could probably qualify for a loan of around $400,000. They'll then issue you a pre-qualification letter. It looks official. It has the bank's logo on it. It has a number on it. But it is built on a foundation of sand. It's an estimate, a guess, a conversation starter. It's the lender's way of giving you a ballpark idea of what you might be able to afford, to get you engaged in the process without having to do any of the real work yet. And no real work is the key phrase here. Because in the real world of real estate, where dreams are on the line and sellers are looking for certainty, no real work translates to no real power. Let me tell you a story. It's a story about a couple named Mark and Sarah, and it's a story that plays out in thousands of different ways, in cities all across America, every single weekend. Mark was a graphic designer, Sarah a third-grade teacher. For 5 years they had been meticulously saving. They cut coupons, drove a 10-year-old car, and had a staycation every summer instead of traveling. Their goal was a small 3-bedroom house in a quiet suburb with a yard big enough for a golden retriever they'd already named Buddy. They had a vision, a dream they'd built together over late-night talks and shared Pinterest boards. One Saturday morning, fueled by coffee and optimism, they decided it was time. They went online to their bank's website and saw a big friendly button that said, "See how much you can afford. Get pre-qualified in minutes." Minutes. It sounded perfect. They clicked it. The form was simple. They typed in their names, their estimated annual incomes. Mark had a few freelance gigs, so he just kind of averaged it out, and their best guess at their monthly debts. They didn't include the small personal loan from Sarah's parents for her car because, well, it was family. It didn't feel like a real debt. For their credit score, they just picked the excellent option from the drop-down menu. They both paid their credit cards on time, so it seemed like a safe bet. They hit submit, and a little loading wheel spun for about 10 seconds. And then the number appeared. $450,000. Felt like winning the lottery. $450. That was more than enough for the kind of house they wanted. They looked at each other, their eyes wide with excitement. This was it. It was real. A printable letter popped up, a PDF with the bank's logo at the top, stating that Mark and Sarah were pre-qualified for a loan up to $450,000. They printed it out, held it in their hands. Felt like a golden ticket. That very afternoon, they called a real estate agent. Their agent, a cheerful woman named Carol, was happy to hear they were pre-qualified. "Great," she said. "Let's start looking." And so the hunt began. For 3 weekends they toured houses. They walked through empty rooms, imagining their future. They pointed out where the Christmas tree would go, where Buddy's dog bed would fit perfectly. They dismissed houses that were too small, or on busy streets, or needed too much work. Why settle? They had their pre-qualification letter. They were $450,000 buyers. They had options. And then they found it. 123 Maple Street. It was perfect. A charming blue colonial with white shutters, a big oak tree in the front yard, and a back deck overlooking a green fenced-in lawn. It was listed at $435,000. Inside, the kitchen had been recently updated with granite countertops, exactly like the ones on Sarah's Pinterest board. It had 3 bedrooms, 2.5 baths, and a finished basement that Mark immediately pictured as his design studio. They walked out onto the back deck, held hands, and knew. This was the one. This was home. Carol, their agent, could see it in their eyes. "It's a hot market," she warned gently. "This one just listed yesterday, and they're having an open house all weekend. There will be other offers." But Mark and Sarah weren't worried. They had their letter. They were ready. They told Carol to write up an offer for the full asking price, $435,000. They wanted to show they were serious. They signed the paperwork electronically, their hearts pounding with a mixture of fear and exhilaration. Carol attached their pre-qualification letter to the offer and sent it off to the seller's agent. And then they waited. The next 24 hours were a blur of nervous energy. They could barely eat. They kept checking their phones, rereading the listing, looking at the pictures of what they were sure was their future home. The call from Carol came on Sunday evening. "I have some news," she said. Her voice wasn't as cheerful as usual. Mark put the phone on speaker. "Did they accept?" Sarah whispered, her hands clasped together. "Well," Carol began, and the long pause that followed felt like an eternity. "They did not accept our offer. They went with another one." The silence in their small apartment was deafening. Mark felt his stomach drop. "What?" "But we offered full price. We have the letter from the bank." "I know," Carol said, her voice full of sympathy. "And I'm so sorry. The seller's agent told me they had 3 offers. Ours, one for a bit less and one for the same price as ours. They chose the other full-price offer." "But why?" Sarah's voice was shaky. "Why would they choose another offer for the same amount? That doesn't make any sense." And here is the gut punch. Here is the lesson that Mark and Sarah learned in the most painful way possible. Because, Carol explained, the other buyers had a pre-approval letter, not a pre-qualification. Mark was confused. "What's the difference? It's just a different word, right?" "No," Carol said, and you could hear the weariness in her voice, a weariness that comes from having this exact conversation far too many times. "It's not just a different word. It's a different world. Your pre-qualification letter. It's based on unverified information. It's an estimate. The seller and their agent know this. They know it's just a printout from a 10-second online form. The other buyers, the ones with the pre-approval, they've already submitted their pay stubs, their tax returns, their bank statements to the lender. A human underwriter has reviewed their entire financial life and has certified with a high degree of confidence that the bank will actually give them the money." So, from the seller's perspective, she continued, they had 2 identical offers on the table. One was a promise from a couple who had a quick chat with a computer. The other was a promise from a couple who had been fully vetted by the bank. One was a maybe. The other was a near certainty. In a competitive market, a seller will always choose certainty. Your pre-qualification letter didn't make you look like a strong buyer. It made you look unprepared. Unprepared. The word hung in the air long after the call ended. Mark and Sarah sat on their couch, the dream of 123 Maple Street dissolving around them. They hadn't just lost a house. They had lost because of something they didn't even know was important. They had walked into a high-stakes negotiation armed with a piece of paper that was, for all intents and purposes, meaningless. Their golden ticket was a promotional flyer. Their foundation of sand had been washed away by the first wave of competition, and they realized that the easy, convenient 10-second process that had made them feel so powerful and so ready was the very thing that had cost them their dream home. That is the devastating power of misunderstanding the difference. So why did it all fall apart? Why did that official-looking letter, the one that felt like a key in their hand, turn to dust the moment it was challenged? To understand that, we have to perform an autopsy on the document they were holding. We have to look past the bank's logo and the big, exciting number printed in bold, and see what a pre-qualification truly is. And what it is an opinion, a guess, a financial handshake based on a 5-minute conversation. It's the banking equivalent of asking someone on a first date, "So you're financially stable, right?" And they say, "Yeah, totally." And you just take their word for it. You haven't seen their credit card bills stuffed in a drawer. You haven't seen their student loan statements. You haven't seen the pay stub that shows what they actually take home after taxes and insurance. You've only heard their side of the story. A pre-qualification is built on one thing and one thing only: unverified information. Let me say that again because it is the single most important concept in this entire video. Unverified information. When our couple called the lender, or more likely, filled out a quick form online, they were asked a few simple questions. "What's your annual income?" And they gave a number. Maybe it was their gross salary before taxes, before their 401k contribution, before their health insurance premiums were deducted. It was the big, impressive number from their offer letter. The lender on the other end of the line didn't ask for a pay stub to confirm it. They didn't ask for the last 2 years of tax returns to see the actual taxable income. They just typed the number into a box. Then the form asked, "How much do you have in savings for a down payment?" And our couple, thinking about their checking account, their savings account, and maybe even some money their parents promised to gift them, came up with a number. A solid, hopeful number. The lender didn't ask for a single bank statement to prove that money was actually there, seasoned, and ready to be wired. They just typed the number into a box. Then came the question about debt. "What are your monthly debt payments?" And the couple did their best to remember. Okay, there's the car payment, that's about $400. And the credit card minimums, maybe $150 total. And the student loans, they're on an income-based repayment plan, so that's what, $200 a month? They added it up. The lender didn't pull a credit report. They didn't see the store credit card they forgot about, or the medical bill that was still outstanding. They certainly didn't calculate what the student loan payment would be on a standard repayment plan, which is what most mortgage underwriters are required to do. They just took the number the couple gave them and typed it into a box. Income, assets, debts, all stated, all self-reported, all unverified. The lender then takes these numbers, these guesses, and plugs them into a very basic calculator. The calculator spits out another number, a maximum loan amount, based on generic industry-standard debt-to-income ratios. The lender then populates a template, a form letter with that number, signs it, and emails it over. The whole process from start to finish can take less than 15 minutes. It's fast. It's easy. It requires zero paperwork. And that is precisely why it is almost worthless. A pre-qualification is not a promise of a loan. It is not an analysis of your finances. It is a marketing tool. It's designed to get you, the potential buyer, in the door. It's a lender's way of saying, "Hey, based on the story you just told me, it sounds like we could probably work together. Let's talk more." It's a house of cards built on a foundation of assumptions. And in a competitive market, the slightest breeze will knock it over. The seller's agent, the one representing the person selling that dream home, knows this. They've seen it happen a dozen times before. They've seen deals get to the final week before closing, only to have the financing collapse because the buyer's actual, verified income was lower than they stated, or because a forgotten debt popped up on the credit report, throwing their debt-to-income ratio out of whack, or because the gift money from their parents wasn't sourced properly and the underwriter couldn't accept it. To a seasoned seller's agent, a pre-qualification letter isn't a sign of a strong buyer. It's a red flag. It signals that the buyer hasn't done their real homework yet. It screams risk. It tells the seller that this deal has a significantly higher chance of falling through, wasting weeks of their time, forcing them to put the house back on the market, and potentially accepting a lower offer later. So when that seller was looking at two nearly identical offers, one from our hopeful couple with their quick and easy pre-qualification, and another from a buyer who had a different kind of letter, the choice was obvious. They didn't choose the other offer because it was a few $1,000s higher. They chose it because it was a sure thing. They chose it because the other buyer had a document that represented hours of work, stacks of paperwork, and a deep, thorough forensic analysis of their finances. The other buyer had a document that was as close to cash as you can get. They didn't have a guess. They had a commitment. Think about it from the seller's perspective. You're making one of the biggest financial transactions of your life. You're trying to coordinate your own move, maybe buy another house yourself. The last thing you want is uncertainty. You want confidence. You want a buyer who is not just saying they can get the money, but who has proven they can get the money. A pre-qualification is a conversation. The other document is a verdict. For our couple, the convenience of that initial 10-minute process was a Trojan horse. It got them onto the battlefield, yes. It gave them the confidence to write an offer. But inside that gift of speed and ease was an army of unverified assumptions, ready to pour out and sabotage their plans at the most critical moment. They didn't lose the house because they couldn't afford it. They lost the house because they couldn't prove they could afford it in a way that mattered. They brought a confident opinion to a fight that required cold, hard facts. And the brutal truth of the real estate world is that facts will always beat opinions. So what is this other document? What is this golden ticket that the other buyer had and our couple didn't? What is the process that separates the window shoppers from the serious contenders and turns a flimsy piece of paper into an ironclad weapon in a bidding war? It's time to talk about the pre-approval. It's time to talk about the work, the verification, and the undeniable power that comes from truly knowing, not just guessing, what you can afford. Because a pre-approval isn't just a different document, it's a different state of mind. It's the difference between hoping you can buy a house and knowing you will. So how do you get that knowledge? How do you transform from a hopeful house hunter into a confident home buyer with the lender's full backing? You embark on what I call the deep dive. This isn't the shallow end of the pool, where pre-qualification happens. This is the part of the ocean where they find the shipwrecks and the treasure. The lender is about to put your entire financial life under a microscope. Sounds intimidating, I know. But think of it less like an interrogation and more like a financial MRI. They're not looking for reasons to say no, they're looking for every possible reason to say yes, but they need the full picture to do it. This is the moment you assemble your financial war chest, the evidence that proves you are ready for the responsibility of homeownership. Let's walk through the arsenal you'll need to bring. First up, the most recent and obvious, your pay stubs. Typically, you'll need them for the last 30 days. This is the real-time proof of your income. It's the pulse, the current heartbeat of your earning power. It shows your gross pay, your deductions, your net pay, the raw, unfiltered truth of what you're bringing in right now. But a single heartbeat doesn't tell the whole story. A lender needs to see the rhythm. That's where the next items come in, your W-2s, and if you're a freelancer or contractor, your 1099s, usually for the past 2 years. Think of these as a time machine. They allow the lender to travel back and see your earning history. Was your income stable? Did it grow? Was there a big unexplained dip? This isn't about judging your career choices. It's about establishing a pattern of reliability. A strong 2-year history tells a lender, this person isn't a fluke. Their income is consistent and dependable. It's your financial resume, and you want it to show a solid track record. Next on the list, and this is a big one, are your federal tax returns for the last 2 years. All pages, all schedules. Why? Because your W-2s tell the lender what your employer says you made. Your tax returns tell the lender what you told the government you made. And you better believe those 2 stories need to match. For a salaried employee, this is usually straightforward. But for the self-employed, the business owners, the gig economy warriors, your tax return is your Bible. This is where you've listed all your business expenses and write-offs. A lender will look at your net income, the number after all those deductions, not your gross revenue. This is a critical point where many entrepreneurs get a harsh reality check. You might have grossed $200,000, but if you wrote off $150,000 in expenses, the bank sees an income of $50,000. Your tax returns are the official, legally binding story of your profitability. Now we move from income to assets. The lender needs to see your bank statements, usually for the last 2 to 3 months for all of your accounts, checking, savings, everything. This is your financial diary. It shows them exactly where your down payment and closing cost money is coming from. And they will scrutinize these statements line by line. They're looking for consistency. They're looking for what they call seasoned funds. Money that has been sitting in your account for a while. Why does this matter? Because of a giant red flag. Large, recent, undocumented deposits. Let's say a week before you apply for a loan, $50,000 suddenly appears in your checking account. To a lender, that's a siren. Is it a gift from a family member that needs to be properly documented with a gift letter? Or more concerning, is it an undisclosed loan from a friend? A loan that you'll have to pay back, which adds to your debt and wasn't factored into your application. That secret loan could torpedo your entire mortgage approval. Every dollar for your down payment needs a paper trail. It has to have a source and a story that the lender can verify. This is not the time for cash under the mattress to suddenly make an appearance. Along with bank accounts, you'll provide statements for any other assets you have. Brokerage accounts for 401(k)s, IRAs, other retirement funds. This helps paint a broader picture of your financial health. It shows you have reserves, a safety net. It proves to the lender that you're not scraping together every last penny for the down payment, leaving nothing left for an emergency, like the water heater exploding the day after you move in. Finally, you'll provide the basics: a copy of your driver's license or other government-issued ID, and your social security number. This is so they can officially confirm your identity and, most importantly, pull your full tri-merge credit report. This is the unvarnished story of your relationship with debt. They see it all: your FICO scores from all 3 bureaus, every credit card you've ever had, every car loan, every student loan, and your payment history on every single one. They see the late payments from 7 years ago and the on-time payments from last week. So you've gathered this mountain of paper. You've handed over the keys to your entire financial kingdom. What happens next? What is the lender, or more specifically the underwriter, actually doing with all this? They are building a case. They are acting as a financial detective, and their one and only job is to answer a single question. If we lend this person several $100,000, what is the statistical probability they will pay it back on time every month for the next 30 years? To do this, they start plugging your numbers into the most critical formula in the mortgage world: the debt-to-income ratio, or DTI. It's simple in concept but powerful in practice. They take all of your monthly debt payments, your student loans, car payments, credit card minimums, and now your proposed new mortgage payment including taxes and insurance, and they add them all up. Then they divide that total by your gross monthly income, your income before taxes. The resulting percentage is your DTI. Imagine your monthly income is a pie. DTI is the measure of how much of that pie is already promised to someone else before you've even bought groceries or paid for gas. Most lenders want to see that number stay below 43%, though some programs allow for higher. If your DTI is too high, it signals to the lender that you might be stretched too thin, that one unexpected expense could push you over the edge into missing a payment. While the DTI is being calculated, they're also verifying everything else. They will call your employer's HR department to confirm you still work there, and to verify your salary. They will cross-reference your bank statements with your pay stubs. They will analyze your credit report not just for the score but for the story. A 680 score from someone who had a bankruptcy 5 years ago, but has had perfect credit ever since, tells a much better story than a 680 score from someone who is consistently 30 days late on their car payment. All of this information, your income stability, your assets, your DTI, your credit history, flows to a single person, the underwriter. This is a real human being whose job is to look at the complete file and give the final stamp of approval. They are the gatekeeper. They follow strict guidelines set by the bank, as well as by entities like Fannie Mae and Freddie Mac, but they also have a degree of discretion. They are trained to spot red flags, inconsistencies, and potential fraud from a mile away. Their signature is what turns an application into an approval, and when they sign off, you get it: the pre-approval letter. This isn't a flimsy estimate. It's a conditional commitment from the lender to give you a specific amount of money. It states the loan type, the loan amount you're approved for, and often, a locked-in interest rate that's good for 60 or 90 days. This is the document that makes real estate agents take you seriously. It's the document that makes sellers see your offer as legitimate and strong. It is, for all intents and purposes, your golden ticket to go find a home. So you have the golden ticket. You've conquered the paperwork, you've passed the underwriter's inspection, and you're ready to make an offer. But this is the exact moment where so many excited buyers make their biggest and most costly mistake. The very pre-approval letter you hold in your hand contains a hidden trap. A detail so small yet so powerful it can kill your deal at the last second, right before closing. And in the next part, I'm going to show you exactly what that trap is, and how you can avoid walking right into it. That trap is not a clause hidden in the fine print. It's not a secret fee or a legal loophole. The trap is you. It's a simple, seemingly innocent action that you might take between the day you get that pre-approval letter and the day you're supposed to get the keys to your new home. It's an action born from excitement and a false sense of security, and it has destroyed more dream home purchases than almost any other factor. This trap is called the final underwriting review, and most homebuyers don't even know it exists until it's too late. You see, that pre-approval letter is not a blank check. It's not a golden ticket. It is a snapshot. It's a photograph of your financial life, your income, your assets, your debts, your credit score, taken at one specific moment in time. The lender looked at that snapshot and said, "Okay, based on this exact picture right now, we are confident we can lend you this much money." But here's the critical part they don't shout from the rooftops. They are going to take another picture. Right before you close on the house, typically within 72 hours of the closing date, the underwriter, the final decision maker, is going to pull out their camera again. They will do a final credit check, they will re-verify your employment, and they will re-examine your bank statements. They are checking to make sure that the person they pre-approved a month or two ago is the exact same financial person standing before them today. If that new picture doesn't match the original, the deal is dead. Let me tell you a story about a couple we'll call Mark and Sarah. They did everything right. They spent 2 years saving every penny for a down payment. They polished their credit scores until they gleamed. They got a rock-solid pre-approval from a reputable lender and went house hunting. After a few weeks, they found it. The perfect 3-bedroom craftsman with a big backyard for their dog. They made a strong offer, it was accepted, and they were over the moon. They'd already started arguing playfully about what color to paint the living room. Their closing date was set for a Friday 3 weeks away. The weekend before closing, they were driving around in Mark's 15-year-old sedan when the transmission finally gave out. The mechanic said it would cost more to fix than the car was worth. Mark and Sarah weren't worried. They had their pre-approval. They were getting a house. They figured, what's one more loan? They went to a dealership, found a reliable SUV that would be perfect for their new life, and financed it. The monthly payment was only $450. It barely made a dent in their budget. They were being responsible. On Wednesday, 2 days before closing, their loan officer called. The tone in his voice was funereal. The final underwriting review had just come through. The underwriter pulled their credit and saw a brand new inquiry and a brand new $25,000 auto loan. That $450 monthly payment had just tipped their debt-to-income ratio, or DTI, over the lender's absolute maximum limit. Let's talk about DTI for a second, because it's the silent killer of mortgage applications. It's a simple percentage. Your lender takes all of your monthly debt payments, student loans, credit card minimums, that new car payment, and adds to it your future proposed housing payment, the principal, interest, taxes, and insurance. Then they divide that total by your gross monthly income before taxes. So if your total monthly debts, including the new house, are $3,000 and your gross monthly income is $7,000, your DTI is about 42%. Most lenders have a hard and fast DTI ceiling, often around 43 to 45%, sometimes a little higher for certain government-backed loans. You cannot exceed this number. There is no wiggle room. Mark and Sarah were pre-approved with a DTI of 41%. They were safely under the limit. But that new $450 car payment pushed their total monthly debts up. Their new DTI became 47%. The underwriter saw that number and stamped a giant red "denied" on their file. The deal was dead. Mark and Sarah lost the house. They lost their $5,000 earnest money deposit. They lost the $700 they'd spent on the home inspection and appraisal. And they were stuck with a new SUV they only bought because they thought they were getting a new garage to park it in. Their dream turned into an absolute nightmare. All because of one single, seemingly logical purchase. This is the trap. The feeling of security that a pre-approval gives you is an illusion. The game is not over until you have the keys in your hand and the deed is recorded. Until that moment, you are in what's called a quiet period. Your entire financial life needs to be frozen in place. You have to treat your finances like a crime scene. Don't touch anything. So, how do you avoid this catastrophe? You need to memorize the cardinal sins of the mortgage quiet period. These are the things you absolutely, under no circumstances, do after you get pre-approved. Number 1. Do not make any large purchases. I don't care if it's a car, a boat, a new living room set from that store offering no interest for 24 months. Don't do it. That no-interest deal still involves opening a new line of credit, and in most cases, will have a monthly payment that affects your DTI. Wait until after you close. Your old sofa will be fine in the new house for a few weeks. Number 2. Do not apply for, open or close any new lines of credit. Don't get a new credit card to get the 10% discount at the hardware store. And just as importantly, don't close old credit cards. You might think closing an account you never use is a good thing, but it can actually hurt you. It reduces your total available credit, which can instantly increase your credit utilization ratio and drop your credit score. Just leave everything exactly as it is. Number 3. Do not change jobs. Lenders prize stability above almost everything else. They want to see a consistent 2-year history of employment. If you switch jobs, especially if you move from a salaried W-2 position to a commission-based or self-employed role, it's a massive red flag. Even changing jobs for a higher salary can complicate things and cause delays, as the lender has to re-verify everything from scratch. If you are even thinking about a career move, talk to your loan officer first. Number 4. Do not move money around or make large undocumented deposits. Every dollar in your bank account that you're using for your down payment or closing costs needs to be sourced and seasoned. That means the lender needs to see where it came from, and it needs to have been in your account for a while, typically at least 60 days. If your grandma gives you $5,000 in cash as a gift for the new house, you can't just deposit it. It will look like an illegal, undisclosed loan to the underwriter. All gift funds require specific documentation, including a gift letter from the donor stating the money is a true gift with no expectation of repayment. Don't deposit cash. Keep a paper trail for everything. And finally, number 5. Do not co-sign for anyone. Even if you're not the one making the payments on that loan, when you co-sign, that debt legally becomes your debt. It appears on your credit report, it's factored into your DTI, and it can absolutely disqualify you from your own mortgage. The golden rule is this: from the moment your pre-approval is issued until the moment the closing is finished, your loan officer is your new best friend. If you are about to do anything that involves a $sign, you pick up the phone and you call them first. You ask, will this affect my loan? Let them be the guide and the gatekeeper. Surviving the quiet period is the final, hidden test of the home buying process. It's a test of discipline. You've already proven you can save money and manage your credit. Now you have to prove you can sit still. But this raises another critical question. We've established that your pre-approval is a fragile snapshot. But is the quality of that snapshot the same no matter who takes the picture? Is a pre-approval letter from a giant national bank the same as one from a local credit union or an online lender? The answer is a resounding no. The piece of paper you use to make an offer on a home carries a reputation with it, the reputation of the lender who issued it. And in a competitive bidding war, having a pre-approval from the right kind of lender can be the single most powerful weapon in your arsenal, the one thing that makes a seller choose your offer over another, even if the other offer is for more money. That's because not all pre-approvals are created equal. And I'm not talking about the dollar amount. I'm talking about the name at the top of the letter. The lender you choose to work with sends a powerful, unspoken signal to the seller and their agent. In the high-stakes game of real estate, where sellers are terrified of a deal falling through, certainty is the most valuable currency there is. And the lender you choose can either scream certainty or whisper risk. Let's break this down, because this is one of the most misunderstood, yet most critical strategic decisions you will make in the entire home buying process. There are generally 4 types of lenders you can go to for a mortgage: big national banks, credit unions, online direct lenders, and local mortgage brokers or direct lenders. To you, the buyer, you might think the only difference is the interest rate they offer. But to the seller and their agent, the difference is night and day. First, let's talk about the big national banks. Think Chase, Wells Fargo, Bank of America. The names you see on every street corner. Getting a pre-approval from them seems like a solid choice, right? They're huge, they're stable, they're reputable. And for you, if you already bank with them, it can feel convenient. But here's the reality from the other side of the table. Big banks are notorious in the real estate world for being slow, bureaucratic, and inflexible. They operate on bankers' hours. Real estate, however, does not. Deals are made on Tuesday nights at 9 p.m. Offers are negotiated on Sunday afternoons. What happens if a seller has a question about your financing on a Friday at 6 p.m.? With a big bank, the answer is usually nothing. You wait until Monday morning. For a seller who wants to get their home under contract and move on with their life, that delay, that lack of accessibility, feels like a massive, unnecessary risk. The listing agent knows that if a snag comes up in underwriting, and snags always come up, Getting it resolved at a big, siloed institution can be a nightmare of navigating call centers and departments that don't talk to each other. So while the name is recognizable, the pre-approval letter itself can be seen as less agile, less reliable, and more prone to delays. Next up, credit unions. People who use credit unions often love them. They're member-owned, they often have fantastic rates, and their service can be very personal. But from a seller's perspective, they often fall into the same bucket as big banks. They can have rigid underwriting guidelines and typically operate on a strict 9 to 5, Monday to Friday schedule. They might be fantastic for a simple, straightforward loan, but in a competitive, fast-moving market, their lack of weekend accessibility and sometimes slower processing times can be a disadvantage that makes a seller nervous. Now for the big one, the rise of the online, direct-to-consumer lender. Companies like RocketMortgageBetter.com and a dozen others. Their marketing is brilliant. They promise a fast, seamless, tech-driven experience, all from the comfort of your couch. And for many buyers, the front-end experience is fantastic. You upload your documents, you get a pre-approval quickly, it all feels so modern and efficient. But I'm going to tell you something that might be shocking. In many real estate markets, a pre-approval letter from a major online lender can be the kiss of death for your offer. Why? It all comes down to that word again, certainty. Listing agents have been burned. They have horror stories. Stories of automated underwriting systems that issue pre-approvals that a human underwriter later denies. Stories of trying to solve a problem and being bounced around a national call center where no one actually knows the specifics of the file. Stories of closings being delayed for weeks because a single piece of paper got lost in the digital ether. When a listing agent can't pick up the phone and call your specific loan officer, a single person who knows you, who has analyzed your file, and who can solve problems, they see a giant red flag. They see a faceless corporation, not a trusted partner. They see a potential for disaster that could cost their seller thousands of dollars and weeks of time. So even if your offer is higher, they might advise their seller to take the slightly lower offer that comes with a promise of a smooth, drama-free closing. This brings us to the fourth category, the one that holds the key: local mortgage brokers and local direct lenders. These are the professionals who live and breathe your local real estate market. A good local loan officer's most valuable asset is their reputation among real estate agents. When a respected listing agent sees a pre-approval letter from a loan officer they know and trust, it's not just a piece of paper anymore. It's a personal endorsement. It's a signal that says, I, a trusted local professional, have personally vetted this buyer. I have reviewed their income, their assets, their credit. I have spoken to them. I am confident they can get this loan. And I will be available nights and weekends to make sure this deal gets to the closing table on time. Let me paint you a picture. Imagine you've found your dream home. You and your agent put together a strong offer. But you know there are 5 other offers on the table. You got your pre-approval from a big online lender because it was fast and they offered a slightly lower rate. Another buyer, let's call them buyer B, submits an offer for $5,000 less than yours. But their pre-approval is from a loan officer named Sarah, who has been working in the community for 15 years and has a stellar reputation for closing loans without any drama. Here's what happens next. The listing agent gathers the offers to present to the seller. They see your offer. It's the highest. But then they see the pre-approval is from Mega Mortgage Online. The agent sighs. They had a deal with them last year that fell apart 3 days before closing. It was a nightmare. They couldn't get anyone on the phone who could help. The seller was devastated. The agent's reputation was on the line. Then they see buyer B's offer. It's a little lower, but the pre-approval letter has Sarah's name on it. Better yet, Sarah had already called the listing agent the moment buyer B submitted their offer. She said, "Hi, this is Sarah. I'm working with buyer B on the purchase of your listing at 123 Main Street. I just wanted to let you know I've done a full underwritten pre-approval. Their debt to income is solid, they have plenty of assets for closing, and we are ready to close in 25 days. If you have any questions at all this weekend, please call or text me directly on my cell." Now, who do you think the listing agent is going to recommend to their seller? The highest offer, attached to a faceless high-risk lender? Or the slightly lower offer that comes with a personal guarantee from a trusted, accessible, and proven professional? 9 times out of 10, they will choose the certainty. They will choose Sarah. They will choose buyer B. That 10-minute phone call from a proactive local lender is often worth more than $10,000 on an offer price. Choosing a local reputable lender isn't just about getting a loan. It's a strategic part of your offer presentation. Your loan officer becomes a key player on your team. Their reputation precedes you and gives the seller confidence not just in your finances, but in the likelihood of a smooth, predictable, and successful transaction. This is the ultimate tiebreaker. It's the inside knowledge that separates savvy buyers from the ones who are left wondering why their highest and best offer was rejected. You are not just submitting numbers on a page, you are submitting a package, a team, and a promise. And the person who makes that promise on the financing side matters more than you can possibly imagine. So let's play this out. Imagine you're a listing agent. It's Sunday night, you've had 15 showings on a beautiful home. And now you have 3 offers sitting in your inbox. You're sitting down with the sellers, the homeowners, to review them. Offer number 1 is for $500,000. It's a solid offer, and it comes with a pre-approval letter from a massive, nationally advertised online lender. Let's call them Quickie Loans. The letter looks generic, like it was spit out by a computer algorithm in 3 minutes. You, the listing agent, have never heard of the loan officer listed at the bottom, and their contact info is just a 1-800 number to a call center in another state. Offer number 2 is for $505,000. A little better. This one comes with a pre-qualification letter. We already know what you, the listing agent, are thinking. This piece of paper is barely worth the ink used to print it. It's based on unverified information. The risk that this deal will collapse in 2 weeks is enormous. The sellers might have to put their house back on the market, losing momentum and potentially thousands of dollars. So this offer, despite being higher, immediately goes to the bottom of the pile. It's a non-starter. Then you open offer number 3. It's for $498,000. It's the lowest of the 3 offers. But attached to it is a pre-approval letter from a woman named Susan Miller at Main Street Mortgage, a local lender right there in town. You, the listing agent, know Susan. You've closed a dozen deals with her over the years. You know that when Susan Miller pre-approves a buyer, she has personally scrubbed their file. You know she's already reviewed their pay stubs, their W-2s, and their tax returns. You know she's had a real conversation with them about their financial goals. Most importantly, you know that if you call her, right now at 7 p.m. on a Sunday, she will pick up her cell phone. You know that if an issue comes up with the appraisal, she will be on it, working to find a solution. You know her processor, you know her underwriter is probably in the same building, and you know her reputation is on the line with every single transaction in this town. So, which offer do you advise your sellers to take? The highest offer with the worthless pre-qualification? Absolutely not. The solid offer from the faceless online lender, where you'll be chasing a call center for updates for the next 30 days? It's a maybe. Or do you take the slightly lower offer that comes with the certainty and peace of mind of a locked-in, fully vetted buyer, backed by a professional you know and trust? 9 times out of 10, they are taking offer number 3. They are taking the deal that is going to close. They are taking the promise made by a person, not a website. The $2,000 difference in price is a cheap insurance policy against the deal falling apart, and the sellers having to start all over again. This is the hidden game within the game of real estate. A pre-approval is not a commodity. It is not just a number on a page. It is a direct reflection of the competence and reputation of the person who issued it. A pre-approval from a well-respected local lender is a weapon. It tells the seller and their agent that you are a serious, qualified buyer who has done their homework and assembled a professional team. An algorithm-generated letter from a national call center tells them you clicked a button on a website. It's the difference between a custom-tailored suit and a cheap one you bought online. They might look similar at a glance, but one is built on a foundation of quality and craftsmanship, and the other is likely to fall apart under stress. And here's the thing, you, the buyer, can level this up even further. You can take this concept and turn it into the ultimate advantage, putting your offer on nearly the same level as a cash buyer. Most people, even most real estate agents, don't talk about this enough. It's the step beyond the standard pre-approval. It's called a conditional loan approval, or sometimes a TBD underwrite. Let's break this down. In a typical pre-approval, a loan officer reviews your documents and says, "Based on what I see, my underwriter will most likely approve this." It's a strong endorsement, but it still has that one final hurdle: the official underwriter review. The underwriter is the final decision maker, the person who works for the lender, and has the authority to give the final stamp of approval on the loan. With a conditional loan approval, you do this backward. You submit all of your financial documents, your tax returns, your bank statements, your pay stubs, everything, to your lender before you even find a house. Your loan officer doesn't just review it. They package your entire file and submit it to the actual underwriter. The underwriter then does a full formal review of your credit, your income, your assets, and your debt. They analyze everything just as they would for a final loan approval. After a few days, they issue a letter. This letter says, "We have fully underwritten and approved this borrower for a loan up to X amount." This approval is firm and is only conditional upon a satisfactory appraisal and title report for a property they choose. Think about the power of that statement. You are no longer just pre-approved. You are, for all intents and purposes, already approved. The financing contingency in your offer, that clause that says you can back out if your loan falls through, becomes almost a formality. The only things left to check are related to the house itself, not you. Is the title clean? Does the house appraise for the purchase price? Those are risks with any offer, including a cash offer that might still want an appraisal. When you submit an offer with a conditional loan approval letter, you are signaling to the seller that the single biggest point of failure in most transactions, the buyer's financing, is already taken care of. It's done. Locked in. Your loan isn't going to get denied at the last minute because an underwriter found something weird on your tax returns. That work has already been completed. This allows your real estate agent to write a much more aggressive offer. They can confidently shorten the financing contingency period from the standard 21 or 30 days down to maybe 10 days. Just enough time for the appraisal. They can tell the listing agent, "My client's financing is rock solid. They have an underwritten approval in hand. We can close this deal as fast as the title company can get the paperwork ready." In a competitive market, this is the equivalent of showing up to a sword fight with a lightsaber. While other buyers are presenting promises from a loan officer, you are presenting a verdict from the underwriter. It screams competence. Screams certainty. It screams, "My offer is the one that will get you to the closing table with the least amount of drama." And how much extra does this cost? Nothing. Zero. It just takes a proactive lender and a buyer who is willing to do the paperwork upfront instead of scrambling to do it after their offer is accepted. You're simply front-loading the work. You are shifting the most stressful and uncertain part of the mortgage process to the very beginning, before the emotional roller coaster of finding a home and making an offer even starts. So when you're choosing a lender, don't just ask, "Can I get pre-approved?" Ask them, "What does your pre-approval process look like? Do you just run my info through a computer? Or do you have a human being review my actual documents?" And then ask the killer question. "Do you offer an upfront, TBD underwriting process to get me a conditional loan approval before I make an offer?" The answer to that question will tell you everything you need to know about the level of service and the strategic advantage that lender can provide. It separates the button clickers from the true mortgage professionals. Getting a pre-qualification is like saying you intend to run a marathon. Getting a standard pre-approval is like showing your new running shoes and a training plan. But getting a conditional loan approval? That's like showing up on race day with your bib already pinned to your chest, ready to go. You've already done the work. Now you just need to find the starting line. So you found the starting line. You walk up to the seller of your dream home, holding that conditional loan approval. And this is where the game completely changes. To understand why, you have to step out of your own shoes as a buyer and put yourself in the seller's shoes for a minute. Imagine you're Sarah. You've lived in this house for 20 years. You raised your kids here. Every scuff on the floorboard tells a story. Selling it is emotional, stressful, and you just want it to be over smoothly and with certainty. You get two offers, both for the same price. One is from pre-approved Paul. His offer comes with a pre-approval letter. It looks good. It says a bank is likely to lend him the money. But you, Sarah the seller, you know what likely means. It means he hasn't gone through underwriting yet. It means his loan could get torpedoed by 1,000 different things you can't see. A weird entry on his credit report, a debt he forgot to mention, an unstable work history. For you, Paul's offer isn't a sure thing. It's a lottery ticket. It might pay off, but you might also have to put your house back on the market in 45 days, right after you thought you were done. Then you look at the second offer. This one is from conditionally approved Chloe. Her offer comes with a letter that says a lender has already put her entire financial life under a microscope. An actual human underwriter has verified her income, her assets, her credit, her debt. They have committed to giving her the loan, with the only remaining conditions being things related to the house itself, a satisfactory appraisal and a clean title search. For you, Sarah the seller, Chloe's offer isn't a lottery ticket. It's cash in a different wrapper. It's certainty. It's peace of mind. It's the difference between hoping the deal closes and knowing the deal will close. Who are you going to choose? 9 times out of 10 you're picking Chloe even if Paul's offer was for a few $1,000s more. The certainty is worth more than the small price difference. That is the incredible power you wield with a conditional loan approval. You're not just a hopeful buyer anymore. You are a powerhouse. You are the seller's dream. You are the path of least resistance. But here's the critical part. Even with that power, even with that nearly guaranteed loan, you can still spectacularly mess it up. The period between getting your approval and closing on the house is a minefield. And most buyers walk right into it completely blind. Let's talk about the 4 landmines that can blow up your home loan at the 11th hour, even after you've been approved. The first and most common is what I call the premature celebration. You get your approval letter, you're ecstatic, and you think, we did it. Now let's go buy a new living room set for the new house. So you head to the furniture store and open a new line of credit for $10,000. Or you decide your 10-year-old car isn't going to look right in the new driveway, so you go finance a new SUV. This is, without a doubt, the single most catastrophic mistake you can make. What you don't realize is that lenders do not stop watching you. They will pull your credit report again, a day or 2 before closing. It's called a credit refresh. When they see that new $25,000 auto loan and that new $10,000 furniture loan, alarms don't just go off, the entire building is evacuated. Your debt-to-income ratio, the very number that got you approved in the first place, has just been shot into the stratosphere. Your pristine application is now a toxic asset. And you get the call you never want to get. It's your loan officer, and their voice is somber. They tell you the loan has been denied. All while your boxes are packed, you've given notice at your apartment, and you've already told your kids which room is theirs. Don't touch your credit. Don't open new accounts. Don't max out existing cards. Don't even let a store do a credit check. For a discount, your credit is frozen in carbonite until the keys are in your hand. The second landmine is the career leap catastrophe. Let's say you get a fantastic new job offer midway through the mortgage process. It's more money, a better title, everything you've been working for. You take it, of course. Why wouldn't you? Because underwriters worship at the altar of stability. They typically want to see a consistent 2-year history of employment in the same field. When you suddenly change jobs, even for a better one, you introduce a massive variable. Are you on probation? Is the new income guaranteed or commission-based? Is it a W-2 job, or are you now a 1099 contractor? Even a promotion at your current company can cause issues if it changes the way you're paid. The underwriter, whose job is to eliminate risk, now sees a giant question mark. The absolute rule here is communication. Before you even think about accepting a new job, you call your loan officer. You explain the situation, provide the offer letter, and let them guide you on how to present this to the underwriter. A surprise job change can kill a deal. A well-documented, pre-approved job change is just another piece of paper in the file. Third, we have the case of the mysterious mattress money. You need $20,000 for your down payment. You've got $15,000 saved in your checking account. Your incredibly generous Aunt Carol gives you the final $5,000 in cash that she had tucked away. You gratefully deposit it into your account, and you've just created a massive problem. In a post-9/11 world, federal regulations require lenders to source every single penny used in the transaction. They need to know where it came from to prevent money laundering. When an underwriter sees a large undocumented cash deposit, they can't just ignore it. They can't prove it's not from an illegal source or, more importantly for them, an undisclosed loan that you have to pay back. Mattress money is unusable. Cash from a side hustle you didn't claim on your taxes is unusable. If you receive a gift, it must be documented with a formal gift letter, signed by the person giving you the money, stating explicitly that it is a gift and not a loan. And they'll need to provide their bank statement showing the money leaving their account. Every dollar needs a paper trail. If it doesn't have one, as far as the lender is concerned, it doesn't exist. Finally, the fourth landmine is the cosigner calamity. Your income is a little low, so you think, I'll just get my dad to co-sign. He has an 800 credit score. This seems like a simple solution, but it's not. When you add a cosigner, you don't just get their good credit score. You get their entire financial profile, warts and all. The lender will pull their credit report and add all of their debts, their mortgage, their car payments, their credit card bills, to your side of the ledger. If your dad has a high debt load himself, even with a perfect payment history, adding him to your loan could actually increase your combined debt-to-income ratio and get you denied. A cosigner isn't a magic wand. They are a full financial partner in the eyes of the bank. You have to analyze their complete debt picture, not just their credit score, before you even consider bringing them on board. Avoiding these 4 landmines is the final crucial sprint in the marathon. It's about maintaining the perfect financial snapshot that got you approved in the first place. You have to think of yourself as being in a financial quiet period. No major changes, no new debts, no mysterious movements of money. But let's say you've done it. You've navigated the minefield perfectly. You have your conditional approval, you found the house, and your offer has been accepted because you were the strongest bidder. Now comes the final step. The one that separates a smart homebuyer from everyone else. It's not just about getting the loan. It's about getting the right loan. How do you ensure you're not getting ripped off on fees? What's the one document you must demand that could save you thousands? And what is the single most important question you can ask your lender that 99% of buyers never think to ask? That's where we're going next. Alright, let's talk about money. Real money. The kind that quietly slips through your fingers at the closing table if you're not paying attention. You've done all the hard work. You've saved, you've polished your credit, you've navigated the treacherous waters of pre-qualification and emerged with a powerful pre-approval letter in hand. You've found the house. You're ready. But this final stage, this is where the banks make their real money. And it's where you can lose thousands or even tens of thousands without even realizing it. So how do you make sure you're not getting fleeced? It all comes down to one single piece of paper. This document is your shield, your sword, and your truth detector all in one. It's called the loan estimate. Let me say that again because it's that important, the loan estimate. By federal law, any lender you apply with must provide you with this standardized, 3-page document within 3 business days of your application. This isn't a suggestion, it's their legal obligation. And if a lender is cagey about giving you one, that's not a red flag. It's a giant, flashing, screaming siren telling you to run in the other direction. Think of the loan estimate as the ultimate price tag for your mortgage. Before this document existed, lenders could give you a confusing mess of papers with fees hidden in the fine print. It was like trying to compare apples to a car engine. But the loan estimate standardizes everything. It forces every lender to present their costs in the exact same format, so you can compare them side by side, line by line. This is your power. So, you've applied to 3 different lenders, a big bank, a local credit union, and an online mortgage broker, just like we talked about. Now you have 3 loan estimates in front of you. What are you looking for? Most people just look at the interest rate and the monthly payment. And that's a rookie mistake. That's what lenders want you to do. They'll dazzle you with a slightly lower rate, while burying thousands in extra fees on page 2. This is where you become a financial detective. Flip to page 2, section A. This section is titled Origination Charges. This is pure profit for the lender. It's the fee they charge you for the service of creating the loan. You'll see line items like origination fee, application fee, underwriting fee, processing fee. It doesn't matter what they call it, it's all the same thing, their paycheck. And here's the secret. Every single dollar in Section A is 100% negotiable. Let's say lender A has a 6.5% interest rate with $3,000 in Section A fees. Lender B has a 6.6% rate, but only $500 in Section A fees. Which is the better deal? It depends on how long you plan to stay in the home, but often, the higher rate with lower fees can save you a fortune up front. You can take lender B's loan estimate with its $500 origination charge, go back to lender A and say, I love your rate, but lender B is only charging me $500 in fees. Can you match that? That one conversation, backed up by proof from the loan estimate, can save you $2,500. Just like that. You don't get what you deserve. You get what you negotiate. Now look at Section B. Services you cannot shop for. These are third-party fees for services the lender orders on your behalf. Think of the appraisal fee, the credit report fee, the flood determination fee. While you can't choose who performs these services, you can and should question the costs. If one lender is charging $600 for an appraisal and another is charging $900, you have every right to ask why. Sometimes it's a legitimate difference based on their partners, but sometimes it's just padding. Then there's Section C, services you can shop for. This is a gold mine. This is where things like the title search, lender's title insurance, and settlement agent fees live. The lender will give you a list of their preferred providers, but you are absolutely not required to use them. You can shop around for these services yourself. A few phone calls to different title companies can often save you another $500 to $1,000. Most people just go with the lender's recommendation out of convenience, but that convenience could cost you the price of a new refrigerator. So, to recap the strategy, get at least 3 loan estimates. Ignore the marketing fluff. Go straight to page 2. Add up all the costs in Section A and Section B. This is your lender's true cost. Compare that number across all 3 documents. Then, use the lowest offer as leverage to negotiate with the lender you actually want to work with. This is how you avoid getting ripped off. You use their legally required transparency against them. It's a beautiful thing. But there's one more layer to this. You've compared the fees, you've negotiated, and you've chosen your champion. You're feeling good. Now is the time to ask the single most important question of this entire process. A question that will instantly signal to your loan officer that you are not a typical, uninformed buyer. A question that 99% of people never think to ask. Are you ready? Here it is. You look your loan officer in the eye, or you type it in an email and you ask this word for word. Before we proceed, could you please explain the relationship between my interest rate and my lender credits? Specifically, if I were to choose a slightly higher interest rate, how many thousands of dollars in lender credits could you offer me to apply towards my closing costs? Let me break down why this question is a secret weapon. Lender credits are a rebate. The lender gives you money to help pay for your closing costs. In exchange, you accept a slightly higher interest rate. For example, they might offer you a 6.5% rate with 0 credits. But if you agree to a 6.75% rate, they might give you a $5,000 credit. That's $5,000 you don't have to bring to the closing table. Why is this so powerful? Because cash is king. For many buyers, the biggest hurdle isn't the monthly payment. It's scraping together the tens of thousands needed for the down payment and the closing costs. That $5,000 credit could be the difference between buying the house and walking away. It could mean you can afford to buy new furniture, or you can keep a healthy emergency fund instead of draining your savings completely. The monthly payment difference between 6.5% and 6.75% on a $400,000 loan is maybe 60 or 70 bucks. For many people, that's a completely manageable trade-off to save $5,000 in cash right now. By asking this one question, you open up a whole new set of options you didn't even know existed. You take control of the financial structure of your loan. You're not just accepting a pre-packaged deal. You're co-creating the deal that works best for your specific financial situation. And once you've settled on the rate, the fees, and the credits, you must do one final thing: lock your rate. An interest rate quote is not a guarantee. It's a snapshot in time. Interest rates can change daily, even hourly. A rate lock is a guarantee from the lender that they will hold your specific interest rate for a set period, usually 30, 45, or 60 days. Once you're under contract on a house, get that rate lock in writing immediately. I have seen people lose their dream home because their rate wasn't locked, rates jumped 0.5% overnight, and they no longer qualified for the mortgage. Don't let that be you. And there it is, the complete journey. From the casual first date of pre-qualification, to the committed relationship of pre-approval, to the marriage contract of the closing table. You're no longer just a hopeful buyer. You're an educated consumer. You understand that the piece of paper in your hand isn't just a letter. It's leverage. You know how to read the fine print, how to question the fees, and how to negotiate from a position of power. You know the one question that can unlock thousands of dollars. The path to owning a home can feel overwhelming. It's designed that way. The confusing jargon, the endless paperwork. It's meant to make you feel small, to make you feel like you should just be grateful for any loan you can get. But you know better now. You know that you are the customer. You are the prize. The lenders are competing for your business. And armed with the right knowledge, you get to decide who wins. This isn't just about buying a house. It's about making the single biggest investment of your life with confidence, with clarity, and with complete control. Go get what's yours.